Revenue up 37%, great performance there. Operating profit up 21%, earnings per share up 16%, dividend of 89 cents, which represents a 16% increase over the previous comparable period. As I said, Arnold Goldstone is with us. Arnold, great solid stuff. I mean, people, if somebody said to any investor that's been in the market for the last 3 to 4 years which stocks have done well, I would bet that probably only about 30-40% would say Invicta, because you're not perceived to be very glamorous, but you go about your business in a very business-like way, and goodness me, as I said in my introduction earlier on in the show, you have yielded great rewards for investors.
Thanks, Lindsay. I'd be surprised if it was even that high a percentage. So Invicta's always been a bit of an unsexy company. You know, we operate in smokestack industries, in a blue-collar industry. I think the investing public in South Africa likes the visible, almost consumer-type stocks, retail-type stocks. And the engineering-type stocks, which ironically form the backdrop of industrial South Africa, just are not sexy enough for them. But, you know, eventually the results speak for themselves.
I think one of the things is as well that people, when they buy a beer, they understand SAB Miller. When they look at Foschini or something like that, they understand the products that Foschini sell. They don't really understand what you do. And if you look at your sectors here, I mean, industrial consumables, which is maybe where we could start your operational review. BMG, you say that it's been a tough market. It's been impacted by labour unrest and in the mining and transportation sectors. So maybe you could tell us what's been going on over the period, because it doesn't sound particularly tough despite the relatively respectable numbers.
I think the numbers belie what is actually happening in the economy, in our neck of the economy. The industrial consumable sector was hard hit towards the end of our half-one period. Only from about August onwards did the labour unrest really start hurting us. So until then, it was business as usual. We had been hurt a little bit by a stronger rand in the first part of the period, so that put a bit of pressure on the BMG or industrial consumable side of our business on their gross margins. But on the whole, it's been a satisfactory experience. You know, South Africa is in a bit of an evolution at the moment, and as a result, there's going to be a bit of unrest. There's always a bit of uncertainty when there's a political change, and we anticipated some sort of slowdown, uncertainty. We didn't anticipate the strikes and the problems that arose from them, but we did expect some sort of slowdown in our sector. What has helped us on the BMG side is making the steady acquisitions as we have every year, year after year. That just increases our base very nicely and helps us to build for the next year. So almost in a quiet way, our group has built steadily over the years. And each year we will continue to do so. So it's operational activity on the one hand, and then acquisition activity on the other.
We'll talk about acquisitions later on, notably the Kian and acquisition that actually we spoke about on Power Lunch 6 or 7 weeks ago, Arnold. Let's go now on to the second part of your business, Capital Equipment Group. Revenue up 50%, operating profit up 58%, steady demand, you say. And this is the one thing that I quite like. Let me just read from your post-results commentary. It says, the period under review for CEG anyway started off slowly, but demand for capital equipment in all sectors grew steadily month by month. That tells me something about the South African economy, or am I reading it wrong? If people are buying capital equipment, it means they're confident about the future. Surely that can't be right.
Don't forget, it's come off a very low base, Lindsay. You know, after 2008, especially after the World Cup soccer, the construction equipment industry was virtually decimated. You know, volumes in the industry fell by 50-60%. So we're coming off a low base on that side. Our capital equipment business cut its costs accordingly on the construction equipment side. So we picked up off a low base. Our overheads have been low, and we've enjoyed the benefit of that with some nice profits coming through. On the agricultural machinery side, there's been sustained demand for agricultural machinery. You know, the full year volume that is being predicted for tractor sales at the moment for this year is around about 8,000 to 8,500 units, which is about 10% or so higher than we had anticipated a few months ago. I think, you know, weather factors have influenced that. In the States, they've just come through a terrible drought, which has affected the maize price worldwide. So we've been able to benefit from that. So I wouldn't read into it that necessarily that there is a big purchase of capital equipment. I think the economy is struggling in South Africa. I don't think it's buoyant. So it may be a little bit misleading looking at our results.
Yeah, you say that the South African economy is struggling, and this comes to the acquisitions. The acquisitions, the smaller ones for CEG and for BMG, all more or less local. But let's talk about the Singaporean acquisition of Kian An. And I think I asked you this question before in our previous interview, but I'll ask it again. Was it anticipatory, this acquisition, because you recognised early on that the South African economy was struggling and would continue to struggle, and therefore you had to diversify your income and earning stream geographically?
You should join our board, Lindsay. That's exactly the reason we did it. We took the view 2.5 years ago that there was too much of our business concentrated in South Africa. We would have run into a problem to grow our businesses because of competition restrictions. So we had to look abroad if we wanted to continue our growth. What we did say to ourselves was, look carefully, don't bet the farm, and stay within your industries. So we put the word out, we put our fishing lines out there, and we've managed to hook one fish already, being Kian An, and we'll continue to look. Our strategy is to grow our businesses in SA as much as we can, and we won't restrict them in any way. And at the same time, look for growth abroad in a steady way. You know, we're not people who risk things easily. We are conservative in the way we run our businesses, and we're always ambitious in our dreams. So it's kind of almost a conflict that exists, or contradiction, but it's worked enormously well for us.
Just one further question, Arnold, if I can. Actually, you've almost answered it. Are the feelers out there? I know you went to one of your advisors and said, look, this is what we're looking for, and they found it for you. And you're not going to, as you said, bet the farm, but there is money available. And if something came up right now, would you go for it?
I'm not sure we would pounce on it immediately. We need to digest what we've done. We've made the Kian An acquisition. That only will come to fruition in early 2013 because there are certain regulatory hurdles we need to get through. We've also made 3 acquisitions in our domestic businesses in the year. So we've got enough on our plate for the time being. But you know, I always say that management capacity should not necessarily be a restriction in growth. So we are busy beefing up our management capacity. We have some wonderful talent in our group, and we are developing that. If the right opportunity came along and the price was right, we would go for it. But right now, we're not looking too aggressively for businesses. We need to digest what we've got.